Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 42 in our series for 2024, and today's date is Friday, November the 15th. First, I'll be talking to Andrew Job, who developed Plotlogic, a tech outfit that helps customers including BHP, Vale, South32 and leading lithium company Pilbara Minerals to precisely understand the location and material properties of every rock in their mine in real time, increasing output and reducing waste and environmental impact. And I'll be talking to EY economist Sherelle Murphy about Australia's latest inflation figures and the response of the RBA. But first, let's talk to Andrew Job. Andrew, tell us about Plotlogic's tech.
Yeah, so our technology is pretty groundbreaking in what we're able to achieve. It hasn't really been delivered before in industry for a long time. And it combines a whole bunch of sensors and artificial intelligence to go into existing mining operations and allow those mines to produce more metal off a lower carbon base. So it makes the mines essentially more efficient, producing the metals we need to power the clean economy, but also at the same time make those mines inherently able to produce that off a lower carbon base.
So tell us about how it actually works. Does it use what you said, artificial intelligence? Does it use advanced imaging, stuff like that?
Absolutely. So the imaging aspect of what we use goes beyond the visible part of the light spectrum. So traditional imagery works in red, green and blue, so 3 color channels, which is what our eyes are used to seeing. Our technology works in the infrared part of the light spectrum as well and goes out into things that we can't see with human eyes, but are really relevant when you're trying to determine different rock and mineral properties. And so collects a huge amount of data. So for a typical camera, there's 3 color channels. For our technology, there's 460 color channels. And then we use that huge amount of information on every single pixel to then run a whole bunch of artificial intelligence over the top of it to predict rock properties.
That would mean it would be much more accurate, wouldn't it, than traditional mining methods?
Absolutely. And that's a big part of how this technology really comes into its fore, because we're able to scan and scan so many rocks really, really quickly and determine those rock properties with a very high degree of accuracy. Gives an unprecedented level of knowledge for mine operators to run their mines very efficiently, so they can make very accurate determinations about the ore material, the waste material, if there's anything that's going to slow the plant down in terms of chewing up a huge amount of energy, all those sorts of things. In the past, there's been a lot of discussion and debate about being able to run mines more efficiently if only this technology exists. And right now the technology does exist, and it's a big change that we've been able to implement over quite a few years of hard work.
That's interesting because, I've covered mining for quite some time, and what I've found was that mines, while terrific while they're operating, they only operate for a few years. And so would this technology extend the life of existing mines?
It does 2 things. One, it allows mines to have their life extended. So, essentially allow you to access parts of the operation that would have previously just been left behind as being too hard to extract. It also means that we can go into previously disused mines where there's a lot of abandoned mines around Australia and around the globe, for that matter, that have, operators have previously gone in with a reasonably crude method, extracted the really good stuff that they could see or access easily, and then left everything else behind. We can now go into those operations that were previously uneconomic or some sort of environmental legacy and use our technology to clean up the operation, go into their stockpiles and dumps, extract the good material from that, and actually use that to help progress the rehabilitation, but also extend the life of those existing operations.
What you can actually do is eke out the last remaining value from a mine in its final years.
That's exactly right. Yeah. So it basically means that new resources are unlocked that previously were tied up or considered to be uneconomic or too hard to access.
And also, can technology also revive other industries?
We at the moment are hyper focused on the mining industry. That's where we've sort of had our expertise in this area, and there's a huge opportunity. It's essentially a $1 to $2 trillion global industry. So we're focusing specifically on the mining domain at the moment. But there's lots of other ways, if you think about the fundamental of the technology, to use this new sensing technology and AI to improve the efficiency of a whole bunch of other industries. It's certainly possible.
Now, I understand Plotlogic was working with Australia's only operating primary tungsten producer. Is that right?
Yeah. That's correct. So we've had a good relationship for some years now with EQ Resources. They have a tungsten operation in far north Queensland. So this is a classic example of an operation where previously those tungsten operations in North Queensland had been mothballed or essentially abandoned because it was too hard to extract the ore profitably. And now, using a different set of technologies, those operations can become a lot more efficiently run and operated. So we're still in development work with EQ Resources and continue to partner with them as we move forward into the future.
Well, I mean, this tungsten sector has been dormant for decades, hasn't it?
Yeah, correct. So, tungsten, is been identified as a critical metal. It's super important for the globe. There is plenty of tungsten in Australia. Australia has some really good, tungsten deposits that are certainly, very valuable. But there's been this technology gap as to how you could actually produce a tungsten efficiently and sustainably. And so there's a huge opportunity using technology, not just our technology, but other technology as well, to go into these existing type of deposits and unlock some value for Australia as we produce these critical metals that are necessary.
Well, while we're talking about tungsten, you've also worked in the lithium industry, haven't you?
Yeah, correct. So we're seeing huge interest in our technology in the lithium space, so that lithium producers in this really growing industry as the world seeks to produce lots of lithium to put into batteries to power the transition away from fossil fuels. A lot of lithium operations suffer the same challenges as other operations, where being able to efficiently extract the lithium in a way that can produce lots of metal and do it off a low environmental and a low carbon footprint is really important. And what we're also noticing with lithium producers and other battery metal producers is the supply chain is seeking to also decarbonize. So it's one thing to produce the lithium for a battery, for an electric vehicle, for example, but the producers are actually looking all the way back up the supply chain to the producers of the raw input metal to say, well, actually, are you decarbonising the way that this metal is being produced as well? So there's more and more pressure being put on lithium producers to not just produce more metal, but do it off a much more sustainable base.
And the beauty of your technology is it allows them to do it in a much more sustainable way.
That's exactly right. So, we have this dual benefit of being able to uplift the metal output from existing operations. So, identify those areas where we can produce literally more metal from the existing operation, and at the same time do it off a lower energy and cost base. So it has those dual benefits that everybody's seeking.
How did you develop the technology?
So it started with my PhD. I'd actually worked in the mining industry for the best part of 2 decades, and then mid-career quit my job with a company called Anglo American. I was a general manager with them to go and pursue a PhD. Super passionate about this space and felt that there was an opportunity to dive deeply. So I spent several years doing a PhD at the University of Queensland, really trying to understand this problem intimately. And then from there, identified this confluence of sensor and AI technology, which essentially formed the basis of the business in 2018 and then have grown from there.
And it's totally proprietary technology.
Absolutely, yeah. So we've got a good, strong patent portfolio that's also growing over time. We pride ourselves on being a really innovative business and always seeking to push the boundaries. So we have great proprietary technology and continuing to build new IP all the time.
Now you're working with mining companies in Australia right now. Are you planning to introduce your technology to overseas mining companies?
We have already started on the overseas expansion. We see ourselves as having an important role to play in the international mining industry. At the moment, we have deployments in Brazil. So we're working with a Brazilian iron ore producer and are currently looking at some expansion cases into other parts of the Brazilian mineral sector. We also have a really exciting project in Indonesian nickel. And so Indonesian nickel is a really important player in the global battery market. They produce well over half of the world's nickel that goes into all sorts of batteries that are needed for a clean economy. And our technology is going into those existing nickel operations and allowing them to produce more nickel and do it in a much more sustainable manner. So we've got existing project that's going through an expansion in Indonesian nickel at the moment. We see that as being a really key market for us as we expand internationally.
So Plotlogic couldn't well become a global company.
We certainly see ourselves as being an international player. Obviously the mining industry is global by nature. There's deposits all over the planet, and we see that our technology can be really beneficial no matter where that deposit is located, whether that's in South America, North America, Indonesia, or other parts of the world. And we sort of are building a business that is focused on being an international player.
And there's nothing quite like it anywhere else in the world, this kind of technology.
Absolutely. We've got a huge advantage in being a front runner in this space. We put a lot of hard work into the early days of building out this significant proprietary technology advantage. At the moment, we've got the lead position, and we want to maintain that lead position by continuing to innovate and continuing to grow our markets and commercialize what we're doing and embed what we're doing. So for us, we're in the lead position, and we want to maintain that and continue to build the opportunity.
Well, Andrew, thank you very much for your time.
It's lovely speaking with you, Ian.
And now let's talk to EY economist Sherelle Murphy.
Well, Sherelle, the latest inflation figures came out. The headline inflation figure was down to 2.8%, which is good, but that was driven by government subsidies. However, the trim mean was 3.5%, which is still above the RBA's target band. And services inflation was high. So the RBA said, look, we're not convinced inflation has sustainably come down, and they're leaving rates on hold for the time being. What's your view about this?
Yes, you're right, Leon. We did see a nice headline number drop, but underneath that, there really wasn't too many great details at all. The core inflation number at 3.5% is quite worrying, because that really is kind of capturing the essence of inflation in the economy, and particularly when we look even more narrowly at just services, that's also, I guess, for the Reserve Bank very relevant, because they tend to be driven by domestic factors. And we can see many aspects of services inflation remaining very high. There's various aspects in there, restaurant meals, trips to the dentist and the hairdresser, and insurance prices are something else that's remaining very high.
So the RBA said they'll leave rates on hold, and it won't be following the line of all the other banks like the Fed now and the Bank of England, which cut their rates.
Yeah, it's really sort of starting to look like a bit of an outlier. And that's obviously for the reasons that the inflation is not suitably within the target band, or at least inflation forecasts are not suitably within the target band for the Reserve Bank. And also, when we think about it, the rest of the economy, it's definitely slowing, but we've still got a strong labour market. And I think the Reserve Bank's view of this problem is that what's your policy of least regret? In this case, it is not doing anything, because they've still got a strong labour market, and they certainly don't want to risk cutting too soon and letting inflation sort of drift away from them again. That's, that would be a complete disaster for the Reserve Bank. So I think from their point of view, just holding tight for the moment is the best plan of action.
But inflation is coming down.
It certainly is. And, we've seen a lot of progress. It's just that on the Reserve Bank's forecasts, they don't expect it to be in the midpoint of that target band, so 2 to 3%, until late 2026. And that forecast hasn't changed from the RBA. So that means that the size of the challenge from the Reserve Bank's perspective really hasn't gotten much better, even though there's been little tweaks to the forecast. They're still looking at some way out before they get where they want to be. And that's why I think Michelle Bullock's language has been so hawkish on this. She's not giving an inch. She said the task is still difficult, and it's still some way ahead of them.
She said they're not ruling anything in or anything out, which is code for saying you still might get a rate hike.
It is, and I must admit I was quite surprised by that. I thought she might drop that language given the fact that we did see some progress on the inflation numbers. But, they're clearly concerned about the strong labour market, what that might do for inflation. Some of the business surveys have given them indications that they don't particularly like. They've also talked, although very carefully, about government spending across both the federal and the state governments. These are obviously adding to aggregate demand, and they are putting some pressure on prices because it's, I guess, putting more demand into a capacity constrained economy. And until the RBA is kind of satisfied that those factors are cooling together, they're still threatening to put another rate hike, which of course is not really particularly welcome news for mortgage holders. I don't think they'll go through with it, mind you, but the threat is there.
It'll be interesting to see what happens with the December quarter inflation figures, which come out just before the February RBA meeting, because the trim mean might come down then to about 3 or 3.1. Of course, we'll have to see what happens with services inflation, but it sort of leaves me wondering whether we could get a rate cut in February.
Yeah, as you say, it all depends really on how the economy progresses between now and then. And if we did see some significant improvement in underlying, and as you say, services inflation, it could open the door to a cut. The RBA doesn't need the underlying inflation rate to be in the target band, but it does need to see it in its forecast plan in the not too distant future. At the moment, it doesn't. So if whatever happens between now and February caused the Reserve Bank to pull down its forecasts, that's when the trigger would occur for a rate cut. My view has been that we were never going to see a rate cut this year, but certainly February was possible. I must admit, I'm veering now on it could be later than that. And that's, I guess, in the context of how strong the governor's language has been about their concerns on inflation. But of course, we now have a new situation in the US too, which we have to kind of consider here. And the Reserve Bank, of course, will be doing the same, trying to understand what that might mean for them. And at the moment, I think that's quite unclear.
Indeed. And the analysts and the economists are saying it could actually leave interest rates higher for longer in Australia, because the Trump has indicated that a more hands-on approach to the Fed.
Yes, and also his policies, which are for increased protectionism, higher tariffs, and a bigger fiscal deficit, are all things that point to higher interest rates in the US as well. So, and that's potentially going to cause some inflation in the US economy. Obviously, the exchange rate will adjust accordingly. The exchange rate in the US could go up and others could go down, but already, even only in the few days since the election, we've seen market moves quite volatile and not necessarily in line with what you would expect. So, US dollar in the beginning rallies and then it comes back a bit. Equities rally, then they come back. The RBA are going to be watching all these movements, everything that Trump, is saying is part of the mix, but until he actually does it, I think they'll be pretty cautious to respond.
Indeed. And so we'll be watching to see very carefully just who Trump gets into his cabinet.
Indeed. And of course, this is still some while away before he actually has the power to do anything. There's still got to get through the next few months, and it's a sort of an early 2025 proposition. And it's for those reasons, by the way, that I think that the Federal Reserve and the Bank of England continued with their course of action to start cutting rates, because there's just too much uncertainty to take them off that path.
So we'll watch what happens very closely. So it could leave rates higher for longer?
I think it certainly at this point does suggest that. And for no other reason than I'm thinking a lot at the moment about the supply capacity of the economy and what Trump's policies do overall. I think is it basically reduces the economy's ability to supply. And that's because you put things like tariffs in the way. You actually kind of create constraints on output. And if you do that and there's sort of no other adjustments, then you are creating an inflationary problem. Now, how that flows through to the US economy what damage it may do to the Chinese economy, which is, of course, our biggest trading partner and the biggest trading partner of 120 countries around the world, is yet to be seen. But it's certainly not good for the Chinese economy, and that can be bad for our economy. So it could actually slow us down, but slow us down on the supply side. So, the implications for rates, if you get that, are that, you could, yes, certainly hold on to higher rates for longer because your economy is constrained.
And Chinese would be buying less from us as their economy weakens as a result of the tariffs.
Presumably, yes, although you would expect that some markets, they may actually come to us to replace the US. And like beef might be one example of that. They do import quite a lot of beef from the US. Do they come to us instead? So that industry could actually get some help. But overall, I think I'm more worried about the implications of the damage that it does to the Chinese economy, what it does to slow down demand there, particularly while that economy is already going through a slowdown and a structural change, which is taking their growth rate lower. So put those things together, and I think we need to keep a really close eye on that one, because huge implications for Australia out of changes in the Chinese economy.
So not only will we be watching our inflation rate, but we'll be watching very carefully what happens in the US next year from January.
I think so. Yeah. The one good thing about all this is that I think economists will remain employed for a long period of time, because the dynamics of these changes are going to be quite interesting to watch, and some of them will be positive and some of them will be negative. And we just have to try and look very carefully to see where the balance lies, to know how our policymakers are going to respond to that.
So what we're left with is a whole series of imponderables.
Indeed. And as I've been thinking about this and answering questions from clients over the last few days, it's sort of a bit on one hand this, on the other hand this. The dynamics of exchange rates and market movements, and how investors are responding to this are all very relevant as well. So I sound like I'm kind of trying to avoid the question here, Leon, and maybe I am, but it is a very difficult one to unravel at this point in time.
Well, Sherelle, we look forward to talking to you next year about this.
Indeed, Leon. Thank you very much again for having me on.
So what's happening in the news? Well, a Wall Street strategist has warned that Trump's proposed trade war raises the chances of a US recession to 75%. In a Friday note, Peter Berezin, the chief global strategist for BCA Research, increased the probability of an economic recession to 75% from 65%, citing the risk of a new trade war under Trump. The prospect of a new trade war more than offsets the other pro-business parts of Trump's agenda. With the labour market already weakening going into the election, the odds of a recession have risen, Berezin said. On the campaign trail, Trump proposed implementing universal tariffs of 10 to 20% on goods imported into the country and a 60% tariff on goods from China. Berezin said those tariffs were likely to depress corporate investment and lower real household disposable income for consumers, representing a double economic whammy. Berezin cited a study from the Budget Lab at Yale that estimates Trump's proposed tariffs could reduce real disposable income for the median US household by $1,900 to $7,600. Some have argued that Trump's tariff proposals are empty threats meant to get leverage when negotiating with other countries, but Berezin isn't so sure. Whether Trump carries out these threats is open for debate. The consensus view among market participants is that, for the most part, he will not. Once again, I suspect the consensus is too optimistic, Berezin said. Berezin is also worried about a potential surge in interest rates since Trump's election win, arguing that they're at restrictive levels that would put downward pressure on economic growth. And Trump's coming return to the White House has significantly upended the outlook for the US Treasury market, where October's losses had already wiped out much of this year's gains. Less than 2 months after the Federal Reserve started pulling interest rates back from a more than 2-decade high, the likelihood that Trump will cut taxes and throw up large tariffs is threatening to rekindle inflation by raising import costs and pouring stimulus on an already strong economy. His fiscal plans, unless offset by massive spending cuts, would also send the federal budget deficit surging. There remains considerable uncertainty about the precise policies Trump will enact. Rick Ryder, BlackRock's chief investment officer for global fixed income, has been telling investors that they shouldn't expect bond prices to rise from here. He said the recent backup is a chance to lock in elevated yields on short-term bonds, but he remains cautious about longer-term debt given the current uncertainty. And Donald Trump has ruled out naming Mike Pompeo, the former Secretary of State and supporter of AUKUS, to his second administration as he moves to build out his cabinet after winning the US presidential election against Kamala Harris. Trump announced that he would not be including Pompeo in the government in a post on Truth Social on Saturday. He also said that Nikki Haley, the former ambassador to the UN, who challenged him for the White House, would not be joining. Both Pompeo and Haley have been critical of Trump before backing him for president in the general election, and his announcement highlights how he is planning to staff his administration with loyalists who have not crossed him recently. Pompeo was seen as a top contender for defence secretary in Trump's second administration, having already served as CIA director as well as Secretary of State in his first. Pompeo has been a staunch advocate for US aid to Ukraine battles the Russian invasion, putting him at odds with Trump and his allies who have been sceptical of helping Kiev. He has criticised Trump in the past for his profligate spending policies and his mishandling of classified documents. Pompeo warned that Republicans needed to be aware of those with fragile egos who refused to acknowledge reality, which was widely viewed as a swipe at Trump. But this year, Pompeo said he would be open to serving in the administration if asked. Haley was much less likely to join Trump for his second term after heavily attacking him during the Republican primary and criticising his campaign in the final weeks of the race. And a US-China economic split under Donald Trump would undermine Labor's plan to ramp up the export of green metals and hydrogen due to interruptions in global trade, according to Treasurer Jim Chalmers. Australia was more exposed to a global trade war than other countries because trade was worth about 50% of Australia's economy, compared with trades in goods and services accounting for about 25% of the US economy, he added. Nobody wins from a trade war, but we have more at stake than most, Dr. Chalmers told the Australian Institute of International Affairs conference on Monday night. US President-elect Donald Trump has threatened to impose tariffs of 10 to 20% on all imports into the country and a 60% tariffs on Chinese goods. Treasurer Jim Chalmers warned that Australia will suffer from lower economic growth and higher prices because of Trump's policies, making Labor's bid for re-election even harder in a contest that will be dominated by the cost of living. Revealing details of Treasury analysis of the economic impact of Trump's return to the White House, Dr. Chalmers said Australia won't escape the impact of a US-China trade war if the President-elect goes ahead with his threat to slug hefty tariffs on Chinese goods. Economists have estimated Trump's policies could shave as much as 1.5% off the size of the Australian economy. With Australians due to go to the polls by May at the latest, it hasn't been lost on either side of politics that Americans' discontent over stubbornly high prices was a key factor in Trump's election. Dr. Chalmers said Australia's floating exchange rate and independent central bank would help mitigate against some of the effects of a trade war. He warned the global impact would be much more substantial. The timing of this and the responses and ramifications that might follow are difficult to predict, but we wouldn't be immune from escalating trade tensions that might ensue. It remains to be seen if Trump's stated agenda is more an ambit claim heading into negotiations with China, or whether a Republican-led Congress would moderate some of his excesses. Economists believe that any slowdown in the Chinese economy because of US tariffs would hurt Chinese demands for Australian goods and services. Dr. Chalmers' warnings of its economic turbulence as Trump presidency signifies for Australia echo similar sentiments expressed by Treasury Secretary Stephen Kennedy, Reserve Bank of Australia Governor Michelle Bullock, and two of Australia's top bank bosses last week. ANZ Chief Executive Shane Elliott said Trump's inflationary policies could mean any cut to Australian interest rates wouldn't come until later next year and would be less frequent than previously expected. An Australian packaging billionaire, Anthony Pratt, has confirmed on LinkedIn that he's moving permanently to the US after receiving a green card last month. "Honoured to be granted my green card for permanent USA residency last month," he said in his post, and cited several reasons for the move, including the fact his family are all US citizens and his significant business interests in the US. Over the past 30 years, we've invested to build 7 factories in America, creating 12,000 well-paying American manufacturing jobs. The announcement comes after Australia's richest woman, Gina Rinehart of Hancock Prospecting, lauded Mr. Trump's policies and travelled to the US to show her support for the US President-elect. Pratt's privately held Pratt Industries is one of the fastest growing players in America's US $35 billion, that's 53 billion Aussie, packaging sector. What he didn't say was he was moving permanently to the US because of his close personal relationship with President-elect Donald Trump, starting with his claim of winning $450,000 by betting my $100,000 on Trump to win the 2016 election. Trump is very much like Pratt's late father Richard, the billionaire founder of Visi. Read into that what you will. Pratt is a long-time Trump believer. This year, a CNN report aired allegations of Pratt trying to buy access to Trump. In a draft copy of a speech Pratt delivered to a Jewish group in late 2019, he describes how he became a member of the Mar-a-Lago resort as a strategic play to secure access to Trump. And victims of work-related sexual harassment do not have the option of reporting incidents anonymously at more than 3 in 10 medium and large companies, discouraging affected employees from coming forward and seeking support. New research from the Workplace Gender Equality Agency indicates that almost all employers have a formal policy on work-related sexual harassment and discrimination, as well as comprehensive processes through which employees can disclose incidents. But 32% of companies with 100 or more employees are yet to set up anonymous reporting channels that allow employees to keep their identities hidden, fueling the underreporting of work-related sexual harassment and restricting employers' ability to eliminate it. The data comes from WGA's soon-to-be-published annual employer census, based on responses from more than 7,000 medium and large employers, covering more than 5 million employees. This year's census was the first in which WGA asked employers how they were preventing and responding to work-related sexual harassment, after the Landmark Respect at Work report recommended the agency collect more data to understand the progress employers were making to eliminate discrimination and harassment in the workplace. While 85% of chief executives were highly engaged in reviewing and approving and communicating harassment policies, the same could not be said for 45% of company boards. There's a bigger role for boards to play in terms of setting that tone right from the top, WGEA Chief Executive Mary Wooldridge said. Employers have been legally required to stop sexual harassment and discrimination before it happens, since a new positive duty was introduced in December 2022. Ms Wooldridge said while the new data in this year's census showed a lot of work was underway to eliminate work-related sexual harassment, it also revealed many employers were failing to meet the Commission's 7 standards. There's still clearly quite a lot of work to do, she said. For example, Sex Discrimination Commissioner Anna Cody said it was concerning that only 51% of employers had reviewed their sexual harassment and policy with workers and unions, which was required under the positive duty. And a senior Nine News executive engaged lawyers within 24 hours of a sudden exit from the media giant last week, amid concerns that the staff clean-out, prompted by the devastating findings of the independent review of the company's workplace culture, could be met with a wave of legal claims. It is understood Nine's Brisbane News director Amanda Paterson contacted high-profile employment and media lawyer John Laxon on Friday after she was called into a meeting on Thursday at the station's Mount Coot-tha headquarters and immediately dismissed. Paterson's departure comes as several senior employees at Nine continue to be investigated over complaints over alleged misconduct that were revealed last month with the release of a cultural review. There is some concern within the company that if due process weren't strictly followed in relation to the legitimacy of the allegations raised in the workplace review, the situation could become a legal nightmare. However, there's also been pressure on management to act quickly amid frustration among staff. The company has been slow to weed out the known perpetrators of unacceptable workplace behaviour. Patterson, who has worked at Nine for 31 years, was a close associate of disgraced news boss Darren Wick, who left the company in March after a female employee lodged a complaint of serious misconduct against him. And consumer advocacy group Choice has wildly overstated the difference in prices between the big supermarkets and discount retailer Aldi, analysis by a Wall Street investment bank has found. JP Morgan's price check of some 100 home brand products across the big supermarket groups found the difference between Woolworths and Coles and Aldi was 8% and 9% respectively, well below the figures published by Choice in a survey commissioned by the federal government. Choice had put the Woolworths price as 35% more expensive and the Coles price 30% higher. The latest Choice report used a basket of 14 commonly bought grocery items like milk, bread, sugar, pasta and fresh fruit and vegetables to conclude that Coles and Woolworths were about a third more expensive than Aldi. The survey included IGA for the first time and found it much more expensive. The cost of everyday groceries has become a significant political issue. Both Labor and the Coalition have sought to pressure the big supermarkets into dropping prices, with Peter Dutton suggesting the government should be able to break up retailers. The choice funding is part of a string of measures unveiled by the Albanese government as it attempts to convince voters that it is trying to reduce the cost of groceries and keep big supermarkets in check. But JP Morgan analyst Brian Raymond claimed Choice's findings did not stack up. The consumer advocacy group does not say which products it is comparing, although it mixes home brand and branded items. As a discount retailer, Aldi sells few products that are not its own brands and keeps costs lower by stocking a far smaller range than its bigger rivals. To effectively compare prices, you need the right weighing of the products, you need unit size comparison to adjust for differences in pack size, you cannot compare private label products across tiers or to branded products, and you need a much larger sample size, said Ms. Raymond of the Choice surveys. Short-term prices on promotion can skew prices. And that's it for this week. And next week I'll be talking to Andy Cunningham, the Senior Regional Director, Australia and New Zealand at Autodesk, about the digital maturity of Australian design and make companies. And I'll be talking to Indeed economist Callum Pickering about Australia's latest jobs figures. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you catch me on Facebook, on X, or formerly known as Twitter, Instagram, LinkedIn, and YouTube. And if you want, leave a comment. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also in my spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles, or editorial, email me. Wishing you all a safe and healthy week, and looking forward to bringing Talking Business next week.